Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. In the last video I did, I got an interesting comment. I showcased the stock Polaris that only had a just slightly above a 2% dividend yield, but it had a lot of growth potential. And one of the comments I got was, that wasn't enough income. And it got me to thinking, and even got us talking around the office here about, I think there's a lot of confusion and even maybe some, I don't know how to put it into words. People just aren't always focused on really what they're investing for. And we believe they should be. For example, one of the common refrains you hear is things like active managers don't outproduce the market. I often get the question, are you outperforming the stock market? And I guess my question is, where is it said that the number one or only goal of investing is to outperform the so-called stock market, especially when you consider that markets can become both overvalued and undervalued. And like I always say, measuring performance without simultaneously measuring valuation is a job half done. The key is, I believe investors should focus more on what they really want and need out of their portfolio. And I make the argument that, you never buy a bond with the primary objective of outproducing, the market. You buy a bond because you think it's stable, you think it's, safe, you think it provides, income and an opportunity to get all your money back, at least in nominal terms. So you have reasons for making investments, and those reasons should always be very clearly in your mind. So what I'm going to do today, I'm going to actually look at 4 real estate investment trusts. I'm going to call these, all of these are what I would call high quality REITs. 3 of them especially, one not so much. They all yield over 4%. One of them actually yields over 8%. And the key here is that these are primarily, I believe, great vehicles for income and for producing current income. So for example, if you're retired or if you're just simply utilizing your portfolio to supplement your current income, even if you're still working, the current income becomes the primary motivating factor for making the investment. So things that are yielding in today's low interest rate environment 4% or more are and should be, in my opinion, very attractive to you. So I'm going to go over 4 REITs that have reasonably high yield. So let's go ahead and get into them. Let's look here at the portfolio review I created. Again, these are all 3 of these are investment grade. One of the Medical Properties Trust is just slightly below investment grade, but it is BB+ rated. So I do consider it a quality REIT, and I'll explain why I say that more. The dividend yields range from a low of 4.46% in Highwoods Properties, which is an office REIT, and a pretty interesting office REIT, I might add. Medical Properties at 5.5%. National Retail Properties, which is a retail REIT, 4.84%. And then Omega Healthcare at the highest yield of 8.83%. So these are all what I would call high-yielding investments in today's low interest rate environment. So I want to go through these, and I want to talk about REITs a little bit in general, but I also want to talk specifically about these REITs, what their historical records look like, and what you could expect to earn on them going forward. So let's start with the highest yielding REIT, Omega. Now, one thing I want to bring up early here in this presentation is, again, REITs are primarily for income. REITs are required by law to pay out 90% of their net distributable income. All right. And income is what, again, REITs are all about. They're not necessarily high growth, although Omega has actually been an above average growing REIT. At least since 2004, they've grown, at a very, what I'll call market competitive rate. But they've also had a great dividend record. You can see that their dividend, which is the white line on this graph, has increased year after year after year. Now, you utilize a form of cash flow called funds from operations for REITs, and I'm going to explain that in a little bit more detail, generally speaking, later in the video here. But that's how you judge REITs. You don't judge REITs on earnings because REITs are investing in hard assets, real estate, obviously. They have all kinds of issues with their accounting when you're looking at just pure earnings, things like, accelerated depreciation schedules and non-cash charges. And even they tend to raise capital, a lot of them do, by issuing new shares. So it kind of muddies up the water, especially when you're looking at share price. But cash flows, sales, revenues, those are the things that net income, those are the things that really, make REITs tick. And that's where the dividend income comes from. Now, You still value REITs based on this funds from operations, or another method of measuring REITs, I should say, is free cash flow, the equivalent free cash flow, or what they call adjusted funds from operations. Now, adjusted funds from operations have only been around for about the last decade or so, and they're not as consistent in how adjusted funds from operations are calculated as we get with funds from operations. So I tend to lean more to the funds from operations just so I can get what I consider to be more standardized data. But AFFO also, or adjusted funds from operations, is a favored metric that a lot of REIT analysts really prefer to use. Frankly, another one that I like to also use, as I'll show you a little bit later, is EBITDA. But looking at Omega Healthcare, what we see here is a company that has had good, consistent growth. Their stock price has been attractively valued for, especially when I'm looking at it against AFFO. And today, I believe it provides a very attractive margin of safety in that it trades only at a 9.66 AFFO, where I believe fair value would be a minimum of 12 times AFFO and even as high as my standard 15 times AFFO. But the company has an AFFO yield right now of over 10%, which I believe is extremely attractive. And again, a dividend yield of 8.83%. Remember, these companies predominantly pay out their dividends. Now, dividend growth has been a part of Omega, but ever since COVID, and obviously this company does senior nursing facilities, so you can obviously imagine the effect that COVID has had directly on their business in the last couple of years, which I think partially explains the low price. So their dividend growth rates have been relatively meager in recent years. 4% in 2018, it dropped to 0.4% in 19, and only 1.1% in 2020, and of course 2021 isn't out yet. But having said that, historically, you can see that this company has generated very nice dividend income growth. Had you invested $10,000 in this REIT on December 29th, 2006, at a price of $17.72, as of yesterday's close, the value of that investment would be $17,133. Okay, that's $7,133 of capital appreciation, if you will. But if you look at the dividend income side, you would have received $15,998 of cumulative dividend income, which increased very nicely year after year after year, albeit slowed down a little bit during this, this COVID time. But your growth yield, as I call it, or yield on cost, as most people refer to it, has been very, very attractive. You can see this has clearly been a great income machine. Now, looking at the company just a little bit, just to give you some insights into the company, I'm going to go into their most recent investor presentation here, which was September of 2021. And this is where they go over some of the, features of the company, like their profile, why invest in them. They talk about skilled nursing facilities, et cetera. I'm just going to highlight this because you can do this yourself by just going into the company's website. And, as far as a snapshot of the company, they were listed originally in 1992. They have $10 billion in investments. Their enterprise value is $14 billion. They have 65 operators of their facilities, 949 properties, and over 96,000 beds. They're investment grade BBB minus rated. And, the dividend yield, of course, because the price has dropped since this was done, is over 8% today, but it was 7.4% when this presentation was built. Now, you can also get some insights into their management team, how many years they've been with Omega. You can see they've got a very experienced management team. They talk about their strategy, how they, are very committed to maintaining their financial strength. All these things are based on how they believe that they create value for their shareholders. And then, of course, they talk about COVID, which was very important as it relates to this kind of company and so on. But you can go through this and do it yourself. The point is, I consider this company, or this REIT, very inexpensive now, trading at a discount to its intrinsic value and even its, discounted market value that the market's been applying in recent years. So if I'm looking at it going forward, I don't expect a lot of growth, okay? For the next couple of years, growth is going to be relatively modest, maybe only 1 or 2 or 3%. But as I said in the opening remarks of this video, not all return comes from high growth or even high yield. This does give me a baseline 8.83% dividend yield right now. But if I can get some FFO expansion, or in this case, adjusted AFFO expansion, back to a more normal multiple of just 12.8 times AFFO, I'm using that with my Graham-Dodd formula. It's not 15 like I normally talk about. I want to make sure you see that. Then by year end, this has a very substantial capital appreciation opportunity here of, over 33% just by the end of the year. If I go out for the next year where I still have 11 analysts, this is as far as I will go with my own view of forecasting. I've got an investment that can generate a 34.5% annualized rate of return over the next couple of years. The majority of that coming from capital appreciation, but I'm also getting a nice kick on, on the dividend as well. But the reason, I'm saying that we're getting $10 of price gain expectation potential versus $3 worth of dividends, but that's simply because of the discount in the value. Here, the return is not on the growth of the business. The return is not even off of the yield of the dividend. The return is off of the discount to intrinsic value, and to be able to capture that upside if the company does, perform. But again, keeping in mind, if I look at this stock from a standpoint of its historical results, and again, the past is not necessarily indicative of the future, a $10,000 investment would have given me almost $16,000 of dividends, but only $7,000 of capital appreciation. So historically, the majority of the return of Omega has come from the dividend, and modestly only about 4% annualized from the capital appreciation. But the way the company sits today at such a discount, that's going to flip-flop at least for the next year and a quarter or so, potentially. I've got most of my return coming from capital gains. But it's a very, very attractive REIT, and a very, very high-quality REIT, and an attractive dividend investment, in my opinion. The next one I want to go to is National Retail Properties. Here I've also got FFO growth. I'm back to FFO here of about 7.3%. Notice the volatility here, and notice the opportunities to buy this REIT at reasonable valuations, not necessarily with the margin of safety that I talked about with Omega, but you do get opportunities to buy it. Now, this REIT does tend to get overvalued quite often. It was overvalued just as early as October of 2019. And, in 2020, October of 2020, it was actually attractively valued. And here we are, coming into October, close to October of 2021, and it's becoming attractively valued again. Historically, going from, we've got a little bit of a headwind with valuation. It was trading back at the beginning of this time frame, January of 2010, at a price to FFO of 17. It's currently trading at a price to FFO of 15.9, or we'll call it 16. So, the rate of return here with roughly 7% growth has been 7.3% capital appreciation, but substantial dividend income. I do want you to see that the dividend income off of this company has been, just extraordinary over this period of time. But looking at it today, I've got almost a 5% yield, 4.8% dividend yield. I've got an FFO yield of 6.29, which simply tells me, from my, real commitment to valuation, I would like to see this one a little cheaper before I personally got interested in investing in it. But if I look at it from a standpoint of, 5.5% growth going forward, at least for the next couple of years, we're looking at 8% for this year, which ends, of course, in a quarter, followed by 5%. If we go out here, we've got a 5.5% rate of return. Most of that would come from dividend. I would want to be buying it when I could get it with a margin of safety like I could last year. So this is one I'd be watching, but I do believe it was close enough to fair value that it was worth a mention in this particular video. Now, I'm finding I'm having trouble with their webpage for some reason. It doesn't seem to be working. But, one thing about this company, it's a dividend aristocrat with 32 consecutive annual dividend increases. So that's something that I think really needs to be understood about this company. And, they do have some great investments and great properties, and I wish I could show it to you, but unfortunately I can't. But you can do that yourself. If you're a FastGraph subscriber, you can just go in to their corporate website. But as I said, right now, that website is not loading, so I apologize for that. But anyway, let's move on. And let's go to Medical Properties Trust. Now, this is another healthcare REIT, if you will, that I think, like Omega, is also very attractively valued. Also has a long-term growth rate of about 6%. If I look at it from a standpoint of historical performance, I do have a little bit of spottiness in their dividend. During the Great Recession, they did cut their dividend 2 years in a row, and then they froze it for 3 years. But then since that time, they've increased it at a pretty nice rate. So if I shorten this and go past, for the last, since 2014 at least, they've been increasing their income by about 4% a year. And again, the value right now is what I would call attractively valued, even offering a margin of safety. So as I look at forecasting here, and this goes back to a 15 AFFO, and again, I'm only going to go out through the end of 2022 here, I could have very substantial 30% plus rates of return with a 5.5% current dividend yield while I'm waiting. The long-term growth rate for this company is expected to be about 4.5%, which is very similar to historical norms. So, I do consider this a very attractive REIT. It's attractively valued and attractively priced. The company's portfolio is interesting. They have a $22 billion portfolio, 446 facilities. They primarily own hospitals in 32 states in 6 European countries, Australia and South America. They have so they operate in 9 countries. 72% are general acute care hospitals, 11% are behavioral health facilities, and then so on and so forth. This is a recent presentation of theirs. So you can see the general acute care hospitals are really their bread and butter product, if you will. Their June investor presentation is one that I would also recommend that you looked at. They have really a lot of detail here and what the company does. They claim they're the second largest non-government owner of hospitals in the world, with gross assets of over $21 billion. And they're at the very heart of healthcare in their own opinion. But again, you can go through this and get a lot of information about the diversity of their portfolios, what kind of facilities they own, where they own them, etc. So this is one that I think is also attractive. Highwoods Properties is another very interesting REIT. It's an office REIT. What I really like about this company, again, it's got its consistent growth. The growth rate here is about 3.5%. I do consider this undervalued. It had a tremendous margin of safety available in October of 2020. It's undervalued again today. When I look at forecast, growth potential, I've got double-digit 26% capital appreciation. I've got 28% capital appreciation, and I've got dividend income coming in at just 4.46%. So I do consider this, very attractively valued. If I look at it from the normal lower valuation the market's been applying of about 14, I still find it to be a double-digit 18%. Annualized rate of return going forward. So I think the company is very attractive. If you want to be conservative, you can, see a nice return if it just moves back into alignment with its blue line. If it gets back to the orange line, which it has done several times historically, as you see here, then the rates of return get into that 25+% over the next couple of years. A 4.46% dividend yield. It's BBB rated, and does have a blended FFO yield of 8%, which obviously is above my 6.5% to 7% threshold. As far as, what the company does and where they are headquartered in Raleigh, North Carolina. They're a member of the S&P Midcap 400. And going into their PowerPoint presentation here to look at them at a glance here, they have 28.3 million square feet of retail space, and they operate in all these various markets here: Raleigh, Austin, Nashville, Dallas, and of course Tampa, St. Pete, my own home here in Atlanta. And they have some, really good properties. They've done really well with collecting their rents. They have some really great tenants that are, taking space in their office buildings. And it's a high quality REIT. I know there's some discussion about office REITs, but these guys are, really keeping their rents up. They're collecting their rents, and the business looks very, very attractive from a standpoint of, fair valuation and growth going forward. Dividend yield 4.46%. So you might want to take a closer look at them. So these are the 4 REITs that I'm featuring here. And I also want to do something here. I want to give you all a little bit of an update on the forthcoming launch. We've made a lot of progress. One of the areas that we were still a little bit behind on was our portfolio. As you can see, we've got the portfolio section functioning pretty well here now. I also want to point out that our fund graph was what was really holding us up. And not necessarily holding us up, but it was the last area we were working on. But we've made a great deal of progress in the financial underlying numbers portion of fast graphs. And we'll be adding a lot of benefits and a lot of features to this. So I did want to at least show it to you and use it to highlight some of the things about these REITs that I think are very, very important. So we're going to start here. I'm looking at Medical Properties Trust. And what I've got noted here are sales and revenue. I want you to notice that sales and revenues have grown, very, very, very nicely. Now, there is another aspect of REITs that I think is very, very important that investors should be aware of when they're evaluating things like a REIT. And this is one of the reasons why you don't use operating earnings. So I'm going to go to diluted shares outstanding here. And we also have basic shares outstanding, but I do want you to notice they're, virtually identical in this company. They're not exactly identical, but diluted would be the ones that would be preferable, I think, to use. And what I do want you to see is that their share count has increased dramatically. Okay, here's a case where a lot of REITs do this. They're constantly increasing their share counts, which makes earnings per share a less than desirable methodology of looking at them. What you really want to look at when you're looking at these companies, or you want to look at cash flows, okay? And, things like operating cash flows and free cash flows. And this is the one I wanted. So net operating cash flows have been growing very, very nicely in the company. But I also want to point something else out when you're looking at these REITs. If you look at it from the balance sheet point of view and look at things like total assets, you can also see that in conjunction with raising the capital that I showed you earlier, they're also increasing their assets, which also is increasing their revenues or their sales, and so on and so forth. So that's one reason why you look at these slightly differently than you do, some of the other companies or some, a regular standard company. And you can see that with, companies like Omega, et cetera. But I did want to just show you that our, fund graphs are getting very close to being fully functioning. We're adding a lot of new features to it. So this was just an update for all the subscribers who have been asking. We're hopefully getting real close. We're going to start testing things. We've got our data loading really well right now, and we've got some neat new features to be adding. So I hope you enjoyed that. Anyway, this has been Chuck Carnevale, presenting 4 REITs that I think are attractive for income today. I hope you enjoyed the video. Hey, give me a like if you did. Ring the bell, subscribe to the channel if you haven't. Help us grow this channel and let us continue to provide, videos like this where we can feature good quality stocks, whether they're growth stocks, dividend income stocks, real estate investment trusts like we did today, et cetera. Anyway, thanks for watching. Be talking to you again real soon.